he's business development director for Jet Aviation. He spent $250 million on expenses at eBay, and is now also going to take us through Hawker Pacific.
Oh, am
I don't know.
I think the piece of good news for everybody is that under the revised schedule of today, Alistair, for some reason, doubled my slot. So we'll either be really quick or I'll do it twice for you, if it prefers. Do we have a clicker somewhere?
They go for the more mature men who've made it in life.
Yeah? Is that why we're having no luck?
No. Haven't started yet. Just building myself up to it.
Yeah, well, you better hurry up. It'll be closing time soon.
All right, all right. I think we're on a winner here, Tree. All right? Play it nice and cool, son. Nice and cool, you know what I mean? Drink up, Trig. Drink up, we're leaving.
20 years ago, there will be a link, I promise you. It's not just a completely irrelevant clip. 20 years ago, I accidentally joined the aviation industry from the Scotch whisky industry. Sort of half the people in the room think, well, that wakes me up, that's quite interesting. The other half think, I was with Mike Walsh last night and I can't face the thought of alcohol in any way whatsoever until about 4:30. I've had mostly development roles through that whole time. The first deal I ever did was an FBO in London Heathrow, which was called Executive Aviation Services. And I think, as Alistair said, I've just recently done the transaction for Hawker Pacific for Jet Aviation, which was $250 million, and we hope a good strategic move for the business. I think over that time, we've seen this huge evolution in the industry, and that evolution is driven by a number of things. One is the economic conditions, the sophistication of the market, and also this sort of general change in the industry as it is come together and consolidated. And I look at it as kind of three distinct buckets. So I'd say when I first started, there was this kind of honest, rational view where people didn't really understand the value of the business. It was a fairly technical transaction, and they would sit down with you and say, okay, how much is it worth? And there was limited buyers, and it was a very personal market with a number of sort of small, everyone calls them mom and pop shops, or small transacting companies. And that kind of went on for a while. And then you take the run up to the great big cliff of 2008 and 2009, and the market got incredibly hot. And everyone says, oh, it's a bit of an irrational market. And I don't actually think it was. I'd say it was an informed market. What was happening was people were buying on a market that was growing at 10, 15, 20% a year. Money was cheap, and you could look at something and say, A, I can borrow cheap money, B, I can grow this thing at 10, 20%, but also there was a huge piece of consolidation going on, which there was still value in consolidation, because consolidation is a game of diminishing returns. And I'll talk about that a little bit later as well. And then I think what you get to today is this kind of myth of a rational seller. The market today is completely irrational. So what you've got is, you've got the quality of opportunities are reducing all the time. You've got sellers' expectations just going up and up and up all the time, and it's completely misaligned. And at the same time, the buyer pool's changing its whole dynamic, because you've got a whole bunch of sort of strategic and industrial buyers that don't have the same, they don't have the same benefit of consolidating the market they have, but there's also quite a lot of cash available. And then you've got a changing financial dynamic that says that the private equity and the sort of free cash money is reducing all the time. And then you've got what we talked about earlier on with some of the DOJ type stuff where people are just not allowed to do transactions because the market's consolidated to an extent. And the consolidation is still tiny. We all say it's amazingly consolidated. It's still an incredibly fragmented market. So there's still opportunity. But this irrationality is real, and it reflects in what you see every day. So last year, across my desk in CJI Aviation, we looked at 27 transactions. And we ended up, we completed on Hawker Pacific. We did another small transaction, and we've got one in process just now, which is a relatively small one. I think of the 27 transactions, so we walked away from 25. Of the 25, I think we missed on bid, maybe 2 or 3, but the rest of them we just looked at and went, why would we do this? Just where do you get your return? And I'm going to keep using the same phrase, which is value creation. If you think about what we're here to do, we create value for our stakeholders. They're either stakeholders that work in the financial markets, they're shareholders in companies, or they're private owners, but we have to create value. And what you're finding with this irrational market today is that people are looking to take value from other people's efforts. So two deals that kind of demonstrate that this year. We had one, it was a seller. It was a top 10 location in the US, and it came to us. He was losing money. He was losing $250,000 a year, and he had a 36-year lease on a building. Nice location, competitive market. There was 4 FBOs in the field. And they sat down and said, okay, we want to sell the business. Fine. What do you want for the business? $60 million. Excellent. I'm going to buy a $250,000 loss income stream that's going to carry on for the next 36 years for $60 million. This sounds like a deal I want to take to the board. And he said, why is it worth $60 million? Well, if you invest $1 million in building a ramp, then that's going to change the amount of market we can get, so we can get our fair share of market. So you're going to win 25% market share. Okay. Why didn't you do that? Well, we don't really want to. Okay, fine. You want to keep losing 250,000? That's fine. Okay, and then you're a big company, so you can put the price up. Okay, so I can put the price up, but you can't. Yep, you'll get the price up. So that's going to add as well. Okay, so I'm going to invest $1 million, and then I'm going to readjust the market. Yep, that's right. Okay, and then if you build a second hangar, you can fill it full of aircraft. And if you do all these 3 things over the next 4 years, you're going to be making $5.5 million a year, 11 to 12 times multiple. My business is worth $60 million. No, it's not. It's, and this is completely normal in the market just now. The second one was about 3 weeks ago, and a guy came and said, I want to sell my business. And his business was making $8 million a year. And he wanted $360 million for his business. Why would I pay $360 million? Because, and he looked at it and said, you're a strategic buyer. You get these synergies. You can move your fleet into the hangars. You can do this, this, and this. And you say, but that's my value. That's not your value. You can't make enough money to make this business generate $360 million without me or some other strategic buyer or some other activity. So why would you pay the value creation to that person for the value that we create? So the whole debate, and it's a completely normal scenario just now in the industry, where you get all these people, like good old Del Boy, whose little motto was, this time next year, we'll be millionaires. And there's a ton of people that move into this industry just now, stay for 1 or 2 years and think that they can start generating incredible returns by buy, trade, sell. But where's the value creation? To me, value creation is all about costs and synergies and the cost of capital. So what's your ability to create value? I work for CJI Aviation. CJI Aviation is owned by General Dynamics. General Dynamics has got a cost of capital. So they can take that capital and they can give it to me, and I'll put it into a project, and I'll give them back a return. Or they can give it to Gulfstream, or they can give it to Mission Systems, or they can give it to IT, or they can give it to the submarine division that makes boats. But what they're interested in is, where do I get the best long-term value creation for my shareholders? And there's two things. I think there's genuinely things in deals that say there's elements of synergy where you can take cost out. And if you take cost out, it's fine to pay for it because it's a genuine value. But the synergy value is unique to you. And that's something that you've got to pull and say, okay, that's how we get our money back. Because if it costs you, let's take a number, let's say 10%. If it costs you 10% to borrow money, and every company's got a working average cost of capital, then if you can't return more than 10%, you may as well leave it in the bank. Or you may as well give it to another division. So that's the challenge for us at the moment, is finding these things. And as a buyer, when I was doing some research for this, I found these two quotes, which I thought were really good. When you are in that buyer pool, you have to be connected. You have to know what's going on in the industry. And I like that first one that says, the best deals never make it to auction. And as a friend of mine likes to say, if you see an oil deal out of Texas, I passed on it twice. It's a very small industry. Everybody talks the same language. Everyone talks to each other. So there's no unique deals. People, like any sizable organization that's growing, is actively chasing in the market. They're having conversations every day. It doesn't necessarily take a banker to come to you. And I think the other one we do is, a lot of times we just sit it out. Of these 27 deals last year, we sit back. 3 of them will come back, 4 of them will come back, but we'll get there. So it's an interesting time for that. I looked at what's actually happened in the last sort of 3 to 5 years. If you actually strip back, technically we're starting to get back to 2008, pre-sort of 2008 levels. You are starting to see FBO transactions in the industry trading at kind of 10 to 13 times. There's a few of them in there that are kind of funnies that skew it a little bit, and there's also some game playing that makes people try and see that things are not quite as expensive as they are, but a lot of stuff is quite expensive. And then MROs, I'll talk about aircraft management in a second, but MROs are a little lighter on return, and a lot of that's to do with margin and the ability to generate income out of MROs. I think one of the funnies for us as an industry, we talked a lot in the last couple of days about how does e-commerce and IT affect the industry. And I think as an industry, we're quite old-fashioned in how we look at things. We're not that sophisticated. The market catches up. So as we go into aviation-based IT-related elements, it's going to be interesting to see how these things get valued going forward, and how do you sit and look at what is traditionally cost of capital, what's traditionally a return on invested capital that we don't sit with today. So I mean, everybody uses multiples as a proxy. So any conversation you ever have with someone, they'll go, oh, I want X times. And multiples as a proxy is fine just to get you into a range, but there's obviously more sophisticated ways to look at how you transact. I mean, why do they vary? An FBO has generally got a higher multiple than, say, an MRO or an aircraft management business, because you're buying leases, you're buying assets, you're buying a position in an airfield. You've got a risk on customer and brand, but you're also buying network access. The interesting thing about that is you actually get your ability to create value reduces the bigger you get. So if you take the Signature Landmark transaction, which was about $2 billion, and it took Signature from 100 FBOs to 200 FBOs, and what it did to them is they got massive network benefit out of that. So effectively, they kept the customers inside, but they can now compete for 70% of all the fuel in the US. So that's great. For them to move from 70% of fuel access to 79% of fuel access, you need to add another 200 FBOs, because you've got this diminishing value of where are all the big transactions, where are all the big airports. And once you've got coverage at all the big airports, your ability to create value reduces. And it's not that dissimilar in MRO. The wider away you get from hubs, and we talked about infrastructure and assets, and the wider away you get from hubs, the lesser your ability to generate strong returns because you're working on thinner and thinner markets all the time. From an MRO perspective, there's less margin and higher sort of touch labor, so the ratios of what you do are slightly different. They generally trade about 8 to 10 times. The risks there are you sit on approvals. Approvals are valuable. Change of control is a key issue. So a lot of these things to do with deal conditions. Are you a cash buyer? Can you give them an easy transaction? Can you push it forward quickly? These things make a difference, and they make a difference to how people look at deals. Aircraft management to me is really interesting. So I really like aircraft management. I don't like buying it though. And the reason I don't like buying it is because all of these aircraft management people sit on, as everyone who competes in aircraft management knows, you sit on 30, 60, 90-day contracts. And every single contract and every single day you're working hard, and there's people competing for your business. So if you go out there and you spend, say you get an aircraft management company that's doing 10 million, you pay 80 million for it. Well, 3 weeks later, you might not have any contracts. Because someone might start up and they go, okay, then, come to me, we're going to give you this. It's just a cash flow fund. You just need to have enough cash in order to fund the business to transact it. So there's a real risk with retention surety. Now, and so why does it trade at that level? Well, the upside is you get massive return on invested capital because you're not actually putting that much capital into getting strong returns, and there's no ongoing capital to support the contract. You're not building hangars. You're not building volume. All you're doing is labor, and all the labor sits in the back of increasing efficiencies. So to me, that's always an interesting one. I can't comment on aircraft sales businesses because I've never bought one. So if anyone wants to tell me what they're worth, I'll quite happily take that. At the end of the day, though, do you see my pig? It was pink earlier on, it's changed to silver. We've made some money. At the end of the day, we don't pay multiples for businesses. You pay for future value of cash flows because cash is king. You don't go back to the shareholders and say, hey, haven't we got a great multiple? They say, no, I want a great dividend. So the other thing about multiples is you can disguise transaction value and you can disguise difficult business conditions through balance sheet. And of course, if you're buying on multiples of earnings before interest, tax, depreciation, and amortization, then there are things that can happen in the balance sheet that get disguised. So it's all about taking the future value of cash flows and understanding your view of risk and your view of growth. So, I didn't know I was meant to talk about this, so we put a slide in, and as you can see, it's got lots of detail. We bought Hawker Pacific on the 30th of April this year. Thank you, Max, Mr. Ex-Chairman. And I don't think Max would mind me saying, I tried to buy this business 3 times. I really like this business, and I was determined that this time we were going to succeed. And under the previous ownership, and under again direction from the sort of outgoing chairman and management, the business evolved incredibly over the last 5 years, and it's now got a whole proportion of it that you can really see stability in future earnings. It's got a clean revenue base that you can look at. Plus, you've got opportunity for upside. So So the kind of why we buy it. We're a strategic buyer. We're an independent MRO provider. We work for all the OEMs. We're not a financial buyer. So we do get opportunity to create value and pay a bit more than other people could for it. Why would that be? Number one is because we take out the cost duplication, but second is we get synergy benefit where we can get growth. What you count in the transaction are 2 different things. It expanded Jet Aviation's reach. It expanded our scope into some experience in military contracting and also some rotorcraft stuff. And the big benefit for us, cost duplication-wise, was one Singapore site. For people who've been to Seletar, there's the two sites that both CJI Aviation and Hawker Pacific have are physically side by side. So we can create one master site. How do we value it? We took the projections from management for the next 10 years, and then we completely discounted them. We built a view of the future that we believed. We then applied some cost savings that build a value piece. We didn't build a synergy piece in because, again, we got to take that value. And then we do two things. We look at what's our view of growth. So we build a relatively short model, and then we apply a terminal value based on growth. So we take that view of growth and we say, right, we believe that perpetually the business can grow like this. And then we take a measure of risk. So we apply a discount rate based on what's our cost of capital and what do we see the risk of the cost of capital in the future. And that gets us to a generic value. I think one of the advantages we have as a buyer is because General Dynamics is a fairly large company. It's a $40 billion organization that throws off about $4 billion of cash a year. So we can be all cash, so we're relatively easy conditions. And we ended up being, thankfully being successful in a strong and good competitive auction. So we like the business, we like what it brings to our network, we like the future expansion, and for us, we think it was a good deal, and we hope it was a good deal for the sellers. So when it comes to the kind of real, what's your business worth? There's no real answer. The technical answer is the future value of cash flows, and everybody values differently. There's a large private equity-based fund in the US. They value lease life, so they basically say every sort of year or every 2 years I can get on my lease. It reduces my cost of capital discount, so they push out for lease life all the time. We happen to cash flows and risk-based on sort of internal numbers. So there are technical questions like, what is it worth? Yeah, you can lay it down on a piece of paper, but the real answer is whatever someone's willing to pay for it. You might be lucky, but you might not. And if someone's willing to pay for your business, then never forget, cash is king, and take the money today. And that was my 40 minutes. Done.
So basically the end of it, your answer is, what is someone prepared to pay? That was great insight, thank you.
You're welcome.
Do we have any questions for David? David, I've got one.
What?
Considering that the underbidder for Hawker Pacific was also an OEM, is this a trend where we're going to see OEMs taking out more and more independent maintenance companies?
Well, I think the first thing to say is CJI Aviation are not an OEM. We're an independent MRO provider that happen to have a sister company that's an OEM. So I think the second thing is both officially and legally, we don't know if the underbidder was an OEM, so I won't comment on that side. If, however, the underbidder was an OEM, subject to confidentiality risks, I think if you look at the evolution of the MRO world, there is a growing trend for OEMs to be in control of their own destiny by way of support functions, and it's a very large part of their business. So certain unique assets give people access to a spread of facilities and cover in order to allow them to grow their fleet and support their fleet in region. So there's I think we will see OEMs looking at where they can expand ready-made into growing regions and not necessarily doing it in established regions.
Okay, any more questions? If not, then thank you very much. That was great. Thank you.